did in the December of 2022. So let's go to this particular question here. December of 2022, which is the question 1B. Question 1B. Question 1B. Question 1B. Question 1B. Question 1B. So once you get that question, please confirm. Once you get that question, please confirm. Once you get the question, please confirm. Please confirm. Yes, are you there? If you have the question with you, please confirm. Please confirm. Yes, so I hope you are there. Are you there? Are you there? Do you have the question with you? Yes or no? Are you there? If yes, yes. Okay. So what are we told here? What are we told? So the question is, 𝗖𝗄𝗄𝗃 Limited leased a factory to 𝗘𝗅 Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rentals of 4 million payable in arrears. So the lease contract provided that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15%. So what are we required to do here? We are required to demonstrate with the suitable calculations the accounting treatment of the above lease transaction in the financial statement of 𝗖𝗄𝗄 Limited, the RSO, for the year which ended 30th of June 2023, 2024, 2025, and 2026. The marks allocated there were 10 marks. You can see the information which are given here, very small information, and also the marks allocated are 10 marks. Now, the first thing we need to do is basically to understand what you're required to do. We are required to demonstrate with the suitable calculations how this particular transaction, will be accounted for in the books of account of the 𝗖𝗄𝗄 Limited. 𝗖𝗄𝗄 Limited is the lessor, who is the owner. Now, what you have said is that when the owner of the asset is accounting for the lease, the first thing he needs to do is basically to determine whether the lease is a finance lease or basically the operating lease. That is the first thing we need to do. We need to determine this lease. Is it a finance? Is it an operating lease? Now, which information are we given? Remember, I've said there are usually 4 criteria which you can be able to use to evaluate whether this lease is finance or operating. I think the information which you are given in our question here is what we have in paragraph sentence number 2. Can you go to sentence 2? Sentence 3, actually. Sentence 3. And you are told that this contract provides that the lessee shall be responsible for the insurance and maintenance of the building during the lease term. So the person who leases the asset shall be responsible for what? For insurance and also what? Maintenance. And also what? Maintenance. So the person who leases the asset, that is the lessee here, the lessee is the one to be responsible for this. Basically, what that means is that this, in this particular case, the owner of the asset, who is 𝗖𝗄𝗄𝗃 Limited, transferred the risk and rewards. Because I've said that if you have the responsibility of insuring a building, if you have the responsibility of maintaining a building, it basically means that all the risks associated with that particular building, they have been transferred to you. That's why you are required. Can you insure this building? If something happens to the building, maybe you are the one to incur the cost of maybe doing what? Repairing that building. That's why you have to do what? To insure it. That's why you also have the responsibility of maintenance. So therefore, in this particular list, the owner of the asset transferred the reward and risk associated with the asset to the lessee. And if that is the case, then it means that this is a finance risk. This is a finance what? Risk. And basically, that's the first thing you needed, or the candidate needed to do here to determine whether this is a finance or an operating. Or an operating. Yes, this one is basically a finance. So we can say this is what? Is a finance what? Is a finance risk. Since what? Since the lessee, although this one is not required, remember this is basically for your understanding purpose. So since the lessee is responsible for what? For insurance and what? For insurance and maintenance. For insurance and what? Maintenance. In other terms, the risks associated with the assets were transferred to the lessee. Okay. Now, having said, we have said that the owner of the asset, or basically what the owner of the asset will need to do, number one is to recognize the asset, and number two, to compute something called the net investment in the risk. And basically that's what we need to do here, because you can see we are not even given the value for this asset. So we need to compute what? The net investment in the risk. The net investment in the risk. So we need to compute the net investment in the risk. Net investment in the risk. Investment in the risk. Net investment in what? In the risk. And basically this one we computed on the date when the asset was leased out. So we are told in the first sentence, 𝗖𝗀𝗀𝗀 Limited entered into or leased a factory to Tiena with effect from 1st July 2022. That is basically the date we determine what? The net investment in the risk. Net investment in the risk. So how do we compute this one? I've said basically we add the three values. Remember that format which I've given you. So I've said we add the present value of the risk rentals receivable, risk rentals receivables, risk rentals receivables. So to this we add the present value of the guaranteed residue amount. The guaranteed residue amount. To this we also add the present value of unguaranteed residue amount and guaranteed residue what? Residue amount and guaranteed residue amount. I've been able to explain, I've explained what is the guaranteed residue amount, what is unguaranteed residue amount. Basically, I've said the guaranteed residue amount. This one will only be given whereby there is an agreement between the owner of the asset, the lessor, and the lessee that at the end of the lease term, the asset will be purchased by the lessee. How much amount will the lessee pay when buying the asset? If you check on this particular question here, I think we don't have such information. The only information which are given here, specifically in sentence 2, is the annual rentals to be received. The annual rentals to be paid of 4 million. There is nowhere given information about there being an agreement between the owner of the asset and the lessee that the lessee will buy the asset at the end of the lease term. So we don't have this value here. The guaranteed residue amount, equally we don't have what? And guaranteed residue amount. It basically means that the net investment in the lease will be equal to this, the present value of the lease rentals receivable. Are we given the amount of money the owner of the asset will be receiving each year? Yes. So that information we have it in sentence 2. We are told the lease is for 4 years. So this is basically a lease for 4 years. Year 1, year 2, year 3. So how much amount will the owner of the asset be receiving? So we are told is a lease for 4 years at annual lease rentals of 4 million payable in arrears. Payable in arrears. In arrears means that that amount will be received by the owner of the asset at the end of each year. So that will be payable in what? In arrears. Payable in what? In arrears. So basically what we need to do here is to discount this. So how do we discount this one? We take 4 million. 4 million. We multiply that with the PVIVA, the present value interest factor. Are we given the interest rate? Yes. At the interest rate of 15%. And basically for how many years? 1, 2, 3, 4. For 4 years. For 4 years. So basically what we need to do is to compute this particular value here. So we need to first of all to work out this. So remember the formula which we use. 1 minus 1 plus r, which is 1.15 raised to power negative 4 all over r, which is 0.15. Can we first of all work out this? Let's first of all we work out this. We work out this. So we have 1.15 raised to power negative 4. We less than from 1, or basically 1 minus answer divided by 0.15, and then we multiply that with 4 million. 4 million. So in this case, I'm getting a value of 11 million. 419 913. 913. Is that what you're getting? The final answer? The final answer? Yes. So basically that is what I'm getting here. That is what I'm getting here. Yes. So basically take into account we don't have these two values. So the net investment that is 11, 419, 913. So basically these represent what the owner of the asset would basically receive over what? Over the income. Now, even before we proceed to the next step, assuming this amount is receivable in advance. For example, this one is receivable at the start of year 1, start of year 2, start of year 3, start of year 4. Assuming that is the case. Now, how do we discount this one? This amount which are receivable in advance. How do we discount this one? How do we discount this one? So the same formula here, we change this one to. Okay, there are two approaches. Remember, there are two approaches. Can you remember a formula? This one. Can you remember this formula you did in the topic of FM? 1 minus the 1 plus r raised to power negative n all over r, and then 1 plus r. Can you remember something like this? Can you remember something like this? Yes. Alternatively, instead of using this, you see this amount, the present value of 4 million, which is paid, which is received at the start of year 1, its present value is still 4 million. So you can take 4 million and then you discount these three amounts here. Yes, so you discount those three amounts, this and this and this, but basically here now your n will be what? Would be 3. But you must remember to take this one, 4 million. It's the present value of 4 million received at the start of year 1 is 4 million. Yes. So if you happen to come across such a question, basically remember that. Now, having this, what do we need to do? We need to amortize it. We need to amortize this. So we amortize this by basically preparing the risk amortization schedule. There is amortization schedule. There is amortization schedule. A schedule. There is amortization schedule. Yes. What is the question here? We will the 4 million at the start. Yes. 4 million. Remember this one. When basically accounting, when computing net investment in the list, we take into account the amount to be received. Whether it was received at the start, you must capture that. Unlike what we did yesterday, whereby you said in computing the obligation, in computing the risk liability, we don't capture the amount which has already been paid. Yes. But in this case, you have to capture that. So here we have a column for the years. Remember, this is the risk for 4 years. For 4 years. Then the next column here will be for the net investment in the risk at the start of the year. This one. We can just refer to that as net investment in the risk. NIL. Net investment in the risk. Balance at the start of the year. Balance at the start of the year. Then the next item here, take into account these risk rentals are received at the end of the year. The next column here will be for the interest. And basically this will be an interest income. The owner of the asset has invested in the risk. So he'll be recognizing something called the interest income. So this one will be computed at the rate of 15%. Then the next column here will be for the risk rentals. the lease rentals, which was received, the lease rentals received, and finally, the net investment in the lease at the end of the year, balance carried down. Balance carried what? Down. That's basically how our lease amortization schedule will look like. Now, having this, we basically need to proceed and prepare our lease amortization schedule. The first year started on this date, 1st July 2022. So automatically that year will end on that year of June 2023. And remember, the lease is for 4 years. The other year, that year of June 2024, that year of June 2025, that year of June 2026. That's why if you go to the requirement, basically we are required to show how this lease will be accounted for in the financial statements of 𝗖𝗄𝗄 Limited, basically for those 4 years, 2023, 2024, 2025, 2026. Yes. So we start with the net investment in the lease at the start of year 1, which you have computed here, and that is 11,419,913. So we compute the interest being 15% of this, being 15% of that, 15% of 11,419,913. Yes, what are you getting as our interest? As our interest income, 17,12,987. Is that what you're getting as the interest? As the interest income, Yes, yes. So then from there, we know the amount which was received at the end of year 1 is the 4 million. So 4 million is the amount which was received at the end of year 1. So how do we compute the net investment in the lease at the end of year 1? So we take this one, net investment in the lease at the start of year 1, A, plus interest income, B, minus the lease rentals received. So we have A plus B minus what? Minus C. Minus C like that. Yes. So let's compute this one. So we take 11,419,913 minus 4 million, plus interest minus 4 million. Yes, what are you getting here? 91,32. 8 what? 890. 890. 890. 890. Is that what you're getting? Is that what you're getting? Is that what you're getting? Okay. So then we move to the next year. So this will be the opening balance. This one will be the opening balance here, 91.32, 890. So what will be our interest? We get 15% of that. 15% of that, which will give us what? 1 million. What? 1,369,930. 930, 934, 935, 935, 935. What are you getting here? What are you getting? Okay, so then the lease rentals received still is 4 million here, and we compute the net investment in the lease. The net investment in the lease at the end. So the net investment in the lease, I hope that is the figure given by Fred there. By Fred, 6502, 02,832. I hope that is the value. Fred, that value is correct. Yes. Please confirm what you're getting here. Yes, 35,02,832. 832. 832. Are you getting that value? Are you getting that value? If you're getting that value, please confirm. Okay, so then this now will be the opening balance here. 65,02,832. So what will be the interest income? So we get 15% of that. 15% of that, which will give us what? 975, 425, 425. Is that what you're getting? Yes. So basically, then we know that at the end of year 4, this is the amount which was received. So we compute the net investment that is at the end of year 3. Yes, and that will give us what? 478, 3478, 250 what? 257. Yes, so that will be the opening balance, yeah? 3478, 257. So what will be the interest? 15% of that. So which will be 521, 739, something like that. The amount which was received at the end of year 4 is basically 4 million. So this one, even without computing, should actually give us 0, or basically a figure which is insignificant. What are you getting? You may get a figure which is not significant, an insignificant figure. An insignificant figure, what are you getting? What are you getting here? Should we get, you can see we have a figure over 6. Is it 6? But it should essentially be 0. It should be 0. So the reason why you're not getting exactly 0 is because we have rounded off. Now, is that what the examiner was requiring? Is this what the examiner was requiring? Automatically, no. That's why you can see, if you go to the requirement, we are basically required to demonstrate with suitable calculations. These are the calculations, the accounting treatment of the above list transactions in the financial statement. So in this case, if you come across that question and think that is something explained, you must prepare a financial statement extract to show what is supposed to be recognized over this period of 4 years as an income, or basically as an expense in the income statement, and what was supposed to be recognized in the statement of financial position. Now, in the income statement, what the owner of the asset, which this company which own the asset will recognize there is this amount here. Remember, our company has reached out the asset. It is like the company has invested in a lease. So in the income statement, the company will recognize this. So in the statement of profit or loss, which is the same with the income statement, remember this is an extract part of the income statement. So we need to have our 4 years here. That year of June 2023, that year of June 2024, that year of June 2025, that year of June 2026, like that. So this one will be recognized here, or which it will be recognized as part of the other incomes. Remember, other incomes, we add them to the gross profit. To the gross what? Profit. We add other incomes here, other incomes. So we will have interest income. Interest income. So the interest income for the past year is this one, which is the 1711. That is 17. Which figure is this? This should be. What should not be here? Is it 1? Should the figure be 1712? Yes, 1712. 1712. 987. And then year 2 we have 13. 69. 935. Then we have 975. 425. And then finally we have 521. 739. So that basically what our company recognize as an income within what? The statement of profit or loss, or basically in the income what? Statement. What about in the statement of financial position? Statement of financial position. Now here, our company will recognize something called the net investment in the lease, of which this net investment in the lease we have said to the owner, to the lessor is an asset. To the owner is what? Is an asset. The company has leased out the asset. The company will be earning some income from leasing out that asset. So this net investment in the lease at the end of the year is an asset. But equally, just like what we did yesterday, this net investment in the risk is basically split into two. Non-current assets and basically current assets. Current assets is the amount to be received from the risk within the next 1 year. This is the amount to be received from the risk with for period beyond 1 year. For period beyond 1 year. So therefore, this net investment in the risk, part of it would be captured here as a non-current asset. As a non-current asset, remember we should have 4 years, that year of June 2023, that year of June 2024, that year of June 2025, that year of June 2026. 2026. So we will have net investment in the risk. Net investment in what? In the risk under the non-current asset and also under the current asset. And also under the current assets. Under the current assets, we will also have what? We will also have net investment in the risk. We will also have net investment in the risk. Net investment in the risk. In what? In the risk, net investment in the risk. And just like what we did yesterday, the amount to be recognized here is a non-current asset. Remember, I've said that this is the amount to be received for a period exceeding 1 year. So in the first year, we will take the net investment in the risk at the end of year 2, this one. So, yes. So that is basically what we recognize here as a non-current asset, this one. 65,02,832. In this year, we take this one, which is 34,78,257. What about this year? We check this one, which is basically 0. And this year, we check for 2017, which is equal what? 0. You can see there is not much difference with how we were treating the risk liability as non-current and current. Then we say to determine the net investment, or actually to determine the amount to be recognized as a current asset here, we will get the difference here, the amount, the difference between the net investment in the risk at the end of year 1 and at the end of the year 2. Because the reason why this amount has reduced is as a result of the amount which was received within that year, Yes, so what is the difference between those two values? This and this. So we have 90 what? 91, 32, 890 minus 65, 02, 832. So that will give us 2630, 058. Then we get the difference between those two values. That is 6502, 832 minus 34, 78, 257. That will give us what? 3024, 575. Can you confirm whether you're getting that value here? Is that what you're getting? Is the difference between those two values? Is that what you're getting? Yes, that is confirmed. Then in the next year, we get the difference between these two values there, which is this one. That is 34, 78, 257, like that. And then the last year is the difference between 0 and 0. So basically that one will be 0. That one will be what? Will be 0. So therefore, that basically what is required as far as that question is concerned. And thus you can see the marks allocated there was significant marks, 10 marks, because equally you can see the work which was required there is equally some work. We have some work which is you have to do before you prepare those financial statements, what are extra. So I want us to take a short break of 10 minutes. We come back and then we see what we are going to discuss. I don't know whether we have any other question on this, or now we are going to proceed and look on how we account for the sales risk back. Remember, these are all these what you did in FR, but basically I said there is another concept, sales risk back. Let's take a short break. We come back, we see what we are going to discuss after the short break. So we come back after the short break of 10 minutes. We come back at exactly 9:20. Yes, so I think we can proceed. I hope you're back. Are you back? If yes, please confirm. Are you back? 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 Okay. So I can see there was another question on this last sitting. Let's go to the paper for last sitting. That is August of 2025. August 2025, there was a question on this. Let's look on that question. It basically means that we're going to finish on this topic in our next class because there is another concept which is remaining, and that is the sales risk-back transaction. So the past papers, let me reshare them in the class was up group there. Already reshared. We got to this question for last sitting, August of 2025. So this was a tricky one, although not that tricky. August of 2025. Specifically, this question number what? This was question number 4B. Question 4B. So if you're there, please confirm. Please confirm. Please confirm. August of 2025. Question 4B. Question 4B. Question 4B. Question 4B. Yes, I think maybe for those who are taking the paper, you came across this question. I don't know whether you were able to do it, but it was a tricky one, although not that difficult. Are you there? Yes. So what are we told? What are we told as far as this question is concerned? What are we told? So the question is on 1st of April 2022. Okay, that it should be part B. So we are told on 1st January 2024, 𝗙𝗀𝗀 Limited acquired a large-scale custom-made equipment and leased it to 𝗙𝗀𝗀 Limited for 6 years. So it basically means that who is the owner of the asset here is 𝗙𝗀𝗀 Limited. So the asset was leased to who? To 𝗙𝗀𝗀 Limited. So 𝗙𝗀𝗀 Limited is the lessor, the owner of the asset, and 𝗙𝗀𝗀 Limited is the lessee. So we are told 𝗙𝗀𝗀 Limited, who is the lessee, made an annual payment of 10 million, commencing on 31st of December 2024. The equipment has a useful life of 7 years. 𝗙𝗀𝗀 Limited is responsible for ensuring and maintaining the equipment and is required to pay an additional 1.5 million at the end of each year, provided that the defined performance target is met. So there is some information which are given in that sentence, which basically will help us in terms of knowing that from the owner's point of view, from 𝗙𝗀𝗀 Limited point of view, this is a finance simply because we are told 𝗙𝗀𝗀 Limited is responsible for ensuring and maintaining the asset. So from the owner's point of view, this is what is a finance lease. So then in paragraph 2, we are told 𝗙𝗀𝗀 Limited has guaranteed that the value of the equipment as at 31st of December 2029 will be less, will not be less than 1 million, although 𝗙𝗀𝗀 Limited anticipates that the open market value as at that date will approximately be 2.5 million. What does that mean? In this particular question here, we are given something called the guaranteed residual amount. So the guaranteed residual amount basically is the amount which is guaranteed by who? By 𝗙𝗀𝗀, because you're told 𝗙𝗀𝗀 Limited basically has assured the owner that the value of this particular asset will not be less than 1 million. So that means that if 𝗙𝗀𝗀 Limited will decide to buy this asset, he will pay an amount of how much? 1 million. But you are told now the owner of the asset, that is 𝗙𝗀𝗀 Limited, if he is to offer for sale this particular asset in an open market, he will be able to sell it at 2.5 million. So it basically means that from this information, we can be able to proceed and we compute something called the unguaranteed residual amount. So who can tell us what would be the unguaranteed residual amount from this information which we have? So 𝗙𝗀𝗀 Limited basically is promising the owner that if he will buy the asset at the end of the lease term, he will buy that asset at 1.5. So the owner of the asset believes that if he offers that asset in an open market, he will be able to get a buyer to buy that asset at 2.5. So automatically the unguaranteed residual amount is 1.5. 1.5. Okay. So then we are told that the cost incurred by 𝗙𝗀𝗀 Limited and 𝗙𝗀𝗀 Limited in arranging the lease amounted to 2.1 million and 1.6 million respectively. So these are basically the cost of arranging the lease. And then you're told the rate of interest implicit in the lease is 9.49. You see the need of remembering the formula of computing the present value interest factor of annuities is because, like in this case, even if you have the table, there is no way you can be able to read the values for this from the table. You can see the rate we are given 9.4, and that's why it is always important to remember those formulas. So we are told Mambo Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. I'll be able to explain what is that. Then you're told the following present value factors are given. So we're given the present value interest factors from year 1 all the way to year 6. Remember, this particular list is for 6 years, as per the first paragraph, the first sentence. So we're given the present value interest factors from year 1 all the way to year 6, basically at the rate of 4.94. So what are we required to do? We are required to explain how 𝗙𝗏 Limited we would account for the risk in its financial statement for the year which ended 31st of December 2024 in conformity with IFRS 16. How many months were allocated here? 12 months. You can see this was significant months. And this question was basically poorly performed because, as you can see, the question itself is a little bit tricky, but very simple one. So now, basically what you have said is that this risk here automatically to the owner, that is to 𝗙𝗏 Limited, this one will be a finance risk. This one being that Mambo Limited, the company which is the asset, has the responsibility of ensuring and maintaining that particular good equipment. So therefore, from a 𝗙𝗏 Limited point of view, from the owner's point of view, this is a finance risk. So therefore, we can say this is a finance risk. This is a finance risk. A finance risk to 𝗙𝗏 Limited, since the lessee, remember lessee is Mambo Limited. Mambo Limited has the responsibility to do what? To ensure and maintain. To ensure and do what? Maintain the equipment. That is the first thing which was important for the candidate to know, that this is basically what? A finance risk from 𝗙𝗏 Limited point of view. If that is the case, then we have said that 𝗙𝗏 Limited will have to recognize the asset, remove that asset in his books of account plus the statement for financial position, and then recognize something called the net investment in the risk. So that's what we need to compute here. The net investment in the risk. Net investment in what? In the risk. Net investment in the risk. Net investment in what? In the risk. Net investment in the risk. And basically, we compute this at the inception date of the risk. So the inception date of the risk, as per the first paragraph, the first sentence, this risk was entered into on 1st January 2024. 1st January 2024 is the inception date. 1st January 2024. So we compute the net investment in the risk. So how do we compute this net investment in the risk? We add the values. The present value of what? Of the risk rentals receivable, the present value of the guaranteed residue amount, and in our case, we have the guaranteed residue amount, and the present value of what? Of the unguaranteed residue amount. But if you check in our question here, we are given the present value interest factors from year 1 up all the way up to the year 6. So therefore, in terms of how we are going to compute this one, we need to have a table here. Take into account we are going to use those particular values we are given here. We are going to have year 1 all the way up to year 6, and then we have the risk rentals to be received here, including the guaranteed residue amount. Then we multiply them with the present value interest factors which are given. We get the present values, and then we get the total. So here we will have year 1, year 2, year 3, year 4, year 5, and then year 6. So let's have the amount to be received. There is a rentals receivable. There is rentals receivable. Now, there is some information which are given about the amount to be paid by Mambo Limited. So Mambo Limited in the first paragraph, sentence 2, I hope you can see that. Okay, sentence 1 actually. So we are told on 1st January 2024, 𝗙𝗏 Limited acquired a large-scale custom-made equipment and leased it to Mambo Limited for 6 years. Mambo Limited makes annual payment of 10 million, commencing on 31st of December 2024. These are the lease rentals which will be received by the owner, 10 million each year, and this one is received at the end of the year. But there is also another information which also made the question to be tricky. So can we move to the other sentence? We are told the equipment has a useful life of 7 years, and then you are told in the other sentence, Mambo Limited is responsible for insuring and maintaining the equipment and is required to pay an additional 1.5 million at the end of each year, provided the defined performance target is met. Now, in this case, we are told the company which leased this asset, Mambo Limited, will be required to pay 10 million. So this is basically guaranteed. And then there is another 1.5 million. And we are told that this will actually have to be paid based on a certain performance target being met. So if this particular equipment which was leased by Mambo Limited will be able to meet certain performance target, then this company will be required to pay an additional 1.5. And then there is also another information which is given in addition to that in paragraph 2. Where do we have that information? Not actually paragraph 2, paragraph 3. We are told the rate of interest implicit in the lease is 9.49. And then you're told in the other sentence, Mambo Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. Now, let me ask here, when computing this one, net investment in the lease, whereby we discount the lease rentals receivable, are we going to use 10 million or are we going to use 11.5 million? This plus this. Who can tell us? Which amount are we going to use? Which amount are we going to use? I'm told by Mark 11.5. Which amount are we going to use here? I'm told by Sahin we are going to use 1.5. 1.5. Now, assuming, for example, in year one, this equipment will not meet. This machine will not meet the performance target. Will Mambo Limited be required to pay 1.5? Assuming the machine will not meet the defined performance target? Automatically no. So therefore, the amount which Mambo Limited has to pay is 10 million. And that's basically what the owner of the asset will be expecting to receive at the end of each year. But if, for example, the asset has met the performance target in a certain year, Mambo Limited will be required to pay that 1.5, and the owner will recognize that as an income. So therefore, in computing the net investment in the lease, we will not use 11.5, we will use 10 million, because that is the amount which must be paid. The other 1.5 is basically pegged on how the asset performs. So if the asset does not meet the performance target in a certain year, that amount will not be paid. So therefore, you cannot use that in computing what the owner of the asset expects to receive from the lease. Delta will be work with 10 million. So 10 million here. 10 million is the amount to be received in year one. 10 million in year two. 10 million in year three. In year four, the same amount of 10 million. In year 5, 10 million. In year 6, 10 million. 10 million. But also in year 6 here, remember this when the lease will be coming to an end. In year 6, there is also another amount which will be received here. Actually, two other amounts. Who can tell us the other amount to be received by the owner of the asset at the end of the lease term here? At the end of year 6. How much amount will be received other than this 10 million? There is also another amount to be received. Who can tell us how much is that? So there is guaranteed residue amount, remember. The guaranteed residue amount is basically the amount which the owner of the asset expects to sell the asset. Can you remember that? Guaranteed Mambo Limited has promised to purchase the asset at an amount of how much? Yes. So in our case, we have guaranteed residue amount here. So guaranteed residue amount. So the guaranteed residue amount is 1 million. Is it 1 million? 1 million. That one will be received at the end of year what? Year 6. Also, we are told that if the owner of the asset basically will offer this particular asset, will offer for sale this asset in an open market, is likely to sell it at 2.5. So therefore, we also need to capture the unguaranteed residue amount. The unguaranteed residue amount. So the unguaranteed residue amount here will be the difference between 1 million and 2 0.5. And I think we have already agreed on how to determine that one. So these two amounts, remember, both of them will be received at the end of year 6. Are we together up to that point before we proceed to discount this? And the reason why I'm using this particular approach is because the examiner has given us those particular present value interest factors. Sasa? Yes, that's why I'm using this particular approach here. So having this, then I need to have the present value interest factors. The present value interest factors. So the present value interest factor for year 1 is 0. I'm using the values which are given here. 0.9133, year 2 0.8342, 0.7619, 0.6958, that is year 5, 0.6355, year 6, 0.5804. This is still year 6. We are going to use this 0.5804. This is still year 6. We use this present value interest factor 0.5804. Sawa? Yes. So having those particular values, then we need to proceed and we get the present values. We get the present values. So basically, this is where majority of the students got it wrong, simply because here, majority of the students work with 11.5 instead of 10. Sasa, in this case, I've said you can't work without, you can't capture that 1.5 because this one is pegged. This one will only be paid based on the performance of the asset. So if the asset does not perform expected in a certain year, Mambo Limited will not pay that amount. Will not pay that amount. So remember, Sahin, we can use this other approach here. For example, from year 1 up to year 6, you take 10 million, you multiply that with 𝗖𝗎𝗄 at the rate which you're given here, basically for 6 years. And then this one, you do the same. Present value of this one, you take 1 million times present value interest factor at the rate of 9.49, and basically for 6 years. And then to discount this 1.5, you do the same. By the end of the day, you'll be getting the same answer. Are we together, Sahin? By the end of the day, if you use this approach, you'll be able to get the same answer. The reason why you must work with this approach is because we are already given those values here. But even if you use this particular approach, you can't fail to get the marks. Sasa? Yes, you can't fail to get the marks. So by the end of the day, the objective is to kill the cat here. Sasa? Yes, so there are so many ways of killing a cat. Yes. So what I want us to do here is basically to get these particular values here. So this will give us what? Remember, these are present values. These are present values. So we have, this will give us what? 900, and I think we could have worked with these particular values to what? In thousands of shillings. Yes, let's work with these figures in thousands of shillings. In thousands of shillings. So this one will be 10,000. 10,000 like that. Yes. The same case here. Our figures to be in thousands of shillings, such that this one will be what? This one will be 91.33. Is that the position? Yes, 91.33. The same case, this one will be 83.42, 76.19, 69.58, 63.55, 58.04. What about this one? This one will be 5.8. I think something like that, 5.8. What about the last one? What about the last one, which is 0.5804 times 1500? So this will give us, to the nearest whole number, 871. 871 to the nearest whole number. To the nearest whole number. To the nearest whole number. Now, having that, I want us to get now the total here. The total here. Let's get the total here, which will be the net investment in the list. 81.33 plus 83.42 plus 76.19 plus 69.58 plus 63.55 plus 58.04 plus 580 plus 871. So what are you getting here? I'm getting 40. So confirm what are you getting? 45, 662, 662, 45, 662. Is that what you're getting? 45, 662, 45, 662, 45, 662. I hope that is what you're getting. I hope that is what you're getting. Please confirm, you confirm whether that is what you're getting. So if you're getting that, I want us, we now proceed. We now proceed. And in our question, if you check on what you're required to do here, basically you're required to prepare the financial statement extract for this company, that is 𝗤𝗏𝗀 Limited, the owner of the asset for this year, for the year which ended. That is basically what you're required to do. We're required to explain how 𝗤𝗏𝗀 Limited will account for the risk in the financial statement for the year which ended 31st of December 2024. So I think what we need to do, we basically need to amortize this. And are we going to prepare the amortization schedule for 6 years? No, simply because we are required to show the financial statement extract for 1 year. I think we need to prepare the risk amortization schedule either for 2 or 3 years. Yes, so let's amortize this. There is amortization schedule. There is amortization schedule. There is amortization schedule. Yes, actually, we're going to prepare this for just 2 years because we need to have the net investment in the risk at the end of year 1 and at the end of year 2. Remember, the net investment in the risk at the end of year 2 will be recognized as an uncurrent asset. The difference between net investment at the end of year 1 and year 2 will be recognized as what? As a current asset. So we are going to prepare this just for 2 years. Just for 2 years. Just for 2 years. Remember, here we should have the first year which ended 31st of December 2024, 31st of December 2025, and then you're going to have the net investment in the risk at the start. The net investment in the risk at the start of the year. Then we have a column here for interest income. Interest income. Interest will be computed at the interest rate implicit in the risk. The interest rate implicit in the risk is 9.49. 9.49. And basically here we will have the risk rentals. The risk rentals which was received. And finally, the net investment in the risk at the end of the year. The net investment in the risk at the end of what? At the end of the year. Basically, that's what you're going to have. Yes, so we need to prepare this just for 2 years. So we start with the first year. The net investment in the risk at the start of year 1. The year which ended 31st of December 2024 is this one. 45,662. Yes, now what we need to do is basically we compute the interest income, which will be 4.49. Sorry, 9.49. 9.49. We basically multiply that with 45,662. And that will give us what? That will give us 43. 33. So the risk rentals received at the end of year 1 is basically what we have here, 10. 10. So this one, we should take this plus this minus that. So what are we going to have? 45,662 plus this minus 10. So that will give us 39,995. 995. So what is the what is the interest income times the point? Okay, so we are getting what? We are getting 3796. Is that what you're getting? Yes, that is confirmed by Ida. Thank you, Ida. So then the amount which was paid here was basically 10,000. So what is the net investment at net investment in the risk at the end of year 2? So we have 39,995 plus 37,995 96 minus 10,000, which will give us 33,791. 781. Is that what you're getting? Is that what you're getting? If yes, please confirm. I want us now we have the financial statement extract. Okay. So let's start by preparing the statement of profit or loss extract. And remember, this is basically for the year which ended 31st of December 2024. 2024, we are required to prepare this just for 1 year. Just for 1 year. Now here, what was our company supposed to recognize here? So as part of other incomes, our company was supposed to recognize this amount here. And remember, our figures are in thousands of shillings. So our company was supposed to recognize the interest income. Now, the interest income, this one can also be known as the finance income. Remember, in case of interest expense, the other name for interest expense is finance costs. Equally, the other name for interest income is finance income. So the finance income is this amount here, 43.33. But in this question here, equally this company, the owner of this asset was supposed to recognize 2 other items. And we go to the information which we have in the 3rd paragraph. In the 3rd paragraph, we are told the rate of interest implicit in the list is 9.49%. Mambo Limited achieved the defined performance target as at 31st of December 2024 and made the required payment. Remember, there was an agreement between these 2 companies, the owner of the asset, Pabana, and Mambo Limited, which had released the asset, that if this asset, which was released to Mambo Limited, meets the defined performance target, how much amount is supposed to be paid by Mambo Limited in case the asset meets the defined performance target? Who can be able to remember that value? The amount to be paid by Mambo Limited if the asset is to meet the defined performance target? Yes, that information, we have it somewhere within paragraph 1, the last sentence, that if this asset meets the defined performance target, Mambo Limited will pay 1.5. Now, because you have said this amount is not certain, this amount will only be paid once the performance of the asset meets this asset meets the performance target. So once that amount is paid by Mambo Limited, the owner of the asset, Pabana Limited, will account for that as what? As an income. Will account for that as what? As an income. So therefore, we also need to recognize that here. And that is basically what? Which name can we give to that? We can give, are we given the name for that amount, 1.5, which is to be paid? Yes. So we can just talk over 1.5. 1.5. Yes. Amount received. Amount what? Received. Yes. And we just refer to that as amount received. Although in an examination, what is marked are those values, amount received, and basically based on asset what? Based on asset performance. Based on asset what? Performance. Based on the asset performance, it will be recognized as an income. Then still, there is also another item which was supposed to be recognized in the income statement. Let's go to paragraph 2, the last sentence. Paragraph 2, the last sentence. We are told the cost incurred by Pabana Limited and Mambo Limited in arranging the lease amounted to 2.1 and 1.6. This, remember, is the amount which was incurred in the first year of the lease. So the amount which was incurred by Pabana Limited, which is basically 2.1, that one will be recognized by that company. The income statement is a cost, as an expense associated with the lease. So we can talk of the expense of arranging the lease. Arranging the lease. Actually, this one, let's not mix this one. Let's not mix this one with because these are incomes, automatically that is a cost or is an expense. So we have the cost of arranging the lease. The cost of arranging what? That is the cost of arranging the lease. The cost of arranging the lease is the 2.1. The amount which was incurred by Pabana. The amount which was incurred by the owner of the asset, 2.1. I think those are the 3 items which were supposed to be recognized in the income what? In the income statement. What about the statement of financial position? In the statement of financial position, two items. The net investment in the list, which you are saying, has to be split into two, non-current and current. So let's prepare the statement of financial position for the year which ended 31st of December 2024. So under the non-current assets, current asset, our company will recognize. No, we don't have to get net income. Remember, this is an extract, Steve. This is an extract. We are just showing what was supposed to be recognized here. All the items of incomes and expenses are not included here. We don't have to get the profit or the loss. That's why we are referring to that as an extract. That is not a complete income statement. We don't have to get that. So under the non-current assets, so our company here will recognize something called the net investment in the list. Net investment in the list. And the net investment in the list at the end of year one, and basically which is to be recognized as an non-current asset, at the end of this year will be this amount here. That is 3,781. 791. That's what we recognize here as a non-current asset. Still, under the current assets, we will also recognize, or our company is supposed to recognize the net investment in the list. Net investment in the list, of which the amount to be recognized as a current asset in the first year should be the difference between these two values here. The difference between those two values there. What is the difference between those two values there? What is the difference between those two values there? The difference between those two values there is the 6204. 6204. That basically what was required in that question. The candidates who are able to do that, they got 12 marks. So that basically what was required. But you can see this question was a little bit tricky. But I think the only tricky part was in relation to this amount, which is to be paid 1.5 to be paid annually, and which is based on which is pegged on how the asset perform. I think that was the only tricky part, because you needed to understand that there was guaranteed residue amount of 1 million and a guaranteed residue amount of 1.5. Yes. So that is it. That basically what is required in that question, and that brings us now to the end of that area, how the owner of the asset accounts for the risk. So once we meet in our next class, we look on the last concept as far as this is concerned, how we account for something called the sales risk back. Sales risk backward transaction. So that is what we will be discussing in our next class. I don't know whether there is any question before we wind up. Any question before we wind up? Aaron, any question? Mark, any question? Ida, is there any question? Phoebe, is there any question? Alfio, any question? Douglas, Frederick, Grace, Lewis, Raphael, any question? Steve? Okay, I think there is none. So we stop at that point for now. See you on Saturday as we wind up with this topic. So have a good night. See you on Saturday.